Well, hello. I bet you don't want to hear this, but we are going to be talking about financial management for this second section of week 5. Again, this is a tough week, I get that, but I hope you all are enjoying the material and learning from it because it's so important to what you're going to be doing. Let's start by taking a look at what finance is. Finance can be seen as consisting of 3 major activities: financial planning, financial control, and financial decision making. As you can imagine, these decisions rest very firmly on your accounting and your accounting practices. And so you need to have sound accounting practices in order to be able to make sound financial decisions. There are a number of different kinds of organizations, all of which involve and need to understand finance. We're looking at things like sole proprietorship, where the individual basically owns the business, a partnership, where there's 2 or more people that own the business, corporations, which means that the business is its own entity, but it's held by any number of people. A single person can own a corporation, or it can be owned by a number of different people. An S Corp has a smaller number of owners, and basically they report the taxes directly onto their tax return. It's often a tax savings device. There are trusts and there are nonprofit organizations. As a franchisee, most likely you're working with some version of a sole proprietorship or an S Corp, and you'll want to talk to your accountant to determine how that's going to be held. Each of these have various benefits and detractions. And again, your accountant is probably in a better position to work with you individually in reviewing what's going to be best for you. Ultimately, though, they're going to impact things like the financial decisions you make and how able you are to acquire funds. We know that the acquisition of funds is basically a lifeblood of all businesses. If you can't get money to start up, oftentimes that means you're just not starting up. It's needed to start a business, to operate a business, and to expand a business. And capital can come from several sources. It can be equity. If you think back to our last segment, the $1,000 that you put down on the car or the business of your own money, that's your equity position. It can be debt. The money you borrowed for the balance of the purchase price is debt. And debt can come in a variety of forms. It could be internally generated funds. Let's say I already started the business and my business is making money. My profits keep coming in and they're being added to my equity position, but they were generated from the business itself. Or I could get things like trade credits. Maybe I've been working with a particular supplier and they're allowing me to carry a balance or actually have some sort of credit. So we want to make sure that we're aware of all of the various forms of places or sources of capital for us. And one of the financial decisions that we make is we decide which of those sources we're going to take advantage of. If I have equity, personal equity, and I also have a line of credit, or I can create debt, which one should I choose? And the decision again for that is complex. Let's say I have $10,000 in the bank and I need to buy a $10,000 vehicle. Why not just take all of my money and buy the vehicle for cash? Well, if that $10,000 was the only money I had in the bank and I spend all of it on a car, and then I have some sort of an emergency, or I even have to pay employees or the electric bill, where's the money coming from for the electric bill? Oftentimes we want to make sure that we're at least covering our current obligations or expected outflows of cash before we come anywhere close to depleting our cash reserves. That's one of the places that debt can really come in handy, whether it's a real short-term debt like a credit card or a longer-term debt like a loan from the bank. We want to use these debt opportunities wisely. Also, when we're deciding which debt to choose, oftentimes a bank will give us a better interest rate or the cost of using their money than we might get it in a credit card. So if the bank is going to charge us, and let's say we're going to have to borrow the money for a 5-year period, if the bank is going to lend us this money at 8% and our credit card is going to charge us 15%, it would make sense to use the bank to borrow the money, because our cost of capital, or the amount we're going to pay to use that money, is just about half of what the credit card would charge us. But again, there are different things to weigh as we're making our considerations, much more than I'm going to get into right here at this point. But be aware that each of these decisions is important, and they tend to impact what kind of position you're going to be able to be in to pay back that debt and continue with your operations. Debt financing, it's the largest source of debt financing for small business in the United States, comes from commercial banks. And these loans can either be secured or unsecured. A secured loan involves the pledging of some asset, such as a home, real estate, machinery, or plants, as collateral. In other words, the bank is asking, if you don't repay this money, what can we take from you to get our money back? And so if you pledge your home, your real estate, and you don't pay, they'll throw you out of the house and take the house. So it's a very serious consideration when you're looking at offering some sort of collateral to secure your loan. An unsecured loan doesn't provide collateral, and as such, they're riskier for the bank, because if you don't pay, the bank is out the money. As a general rule, because there's additional risk, the interest rate for an unsecured loan is going to be higher than the rate that you might be able to get for a secured loan, which means generally if you have assets, it makes sense to secure them because it'll save you money in interest expense. Okay? As we were kind of talking about, and I'm going to stick with the car example, we have a choice of how much debt we put in versus equity. When we looked at the car, we put $1,000 of equity, which was our own money, and $9,000 of debt. One of the advantages to that is it left some money in the bank for us to pay other things. The disadvantage is we did end up paying more interest expense to use that debt because we're using somebody else's money. So we don't want to just jump to a conclusion as to which one is best. We want to sit down and figure out the various scenarios when we're deciding how much debt and how much equity to use. One thing that we know in regards to getting debt is you want to try to establish a relationship with your lender. If you've been going to the same bank in your neighborhood for the last 20 years and you've put in regular deposits and you've never overdrawn your accounts and you pay on time and all those kind of good things, and maybe when you come in you say, hey, hi Fred, how's it going? Or hi Nancy, and you establish a relationship. When you come in and need to borrow money, they're probably in a little bit more receptive position to listen to you, right? Because you've established the relationship. You've established a good track, if you will. So spend the time, I guess is all I'm really saying, is dedicate some time to getting to know your local lenders. Do what's right that's going to look good for you, because over the long run it's going to make a difference when you need to borrow some money. Okay? Let's take a look at break-even analysis. It's a remarkably useful to someone considering starting up a business. And really what you're trying to do is find out where it is that you break even. In other words, you've stopped losing money or investing money that's going out, and you're at least covering your costs. Break-even analysis examines potential costs, both fixed and variable. And by the way, fixed costs are things that you pay the same amount every month, maybe like the lease for your business or the car payment. That's a fixed cost. Variable costs tend to adjust with sales. So looking at the sub shop, if I'm selling more sandwiches, I need to buy more bread and more lunch meats, which means those costs are going up with sales. Those are your variable costs. The break-even analysis examines the fixed costs and variable and determines the sales volume that's going to be necessary in order to produce a profit for a given selling situation. Okay? What that does is it lets you know the number of product units or service units you need to sell each and every month so that you're not losing money. The formula is basically your total revenue, which equals the selling price of the unit times the quantity sold. So let's see, how can I make this one easy? Let's say I'm doing massages, and I know that in order to rent the studio, and again I'm going to make up the numbers just to make the numbers easy, I have $10 to rent my studio and $5 to pay the masseuse who's providing that service. So I've got $15 in costs. Now let's say I get, and this is very simplified, so it's not considering everything, but let's say I get $1 a massage. The firm receives $1 per massage given. Well, if I have $15 in expenses, the studio and the masseuse cost, I need to have at least 15 clients to get $15 in revenue. So ignoring everything else, that would be where my costs equal my revenues. So at $15, I've covered my costs. If I actually get a 16th client in, that's my profit. So break-even analysis would show 15 units is my break-even point. Okay? Understanding how we're going to balance my debt or my capital structure, how much equity, how much debt, in order, because remember, those are going to determine my fixed cost points. But understanding how to structure everything is, again, it's a complex situation. Oftentimes your franchisor is going to be able to provide you some of that information. Certainly your accountant can help you with that. In the big picture, what we want to do is we know that we want to create customer value, because the bottom line is we're trying to get at least 15 customers coming in for our massage. If we can get 20 coming in, we have 5 units of profitability. In other words, you can see very directly that increasing sales increases profitability. And increasing sales is done by enhancing customer value. And all of weeks 3 and 4, where we were talking about our marketing strategy, kind of talked about how we can build that up. We want to be able to use computing, whether it be to develop our accounting, to help us reach out for our advertising program. And we want to know what our numbers are. Where do we make money? Where are we losing money? And how can we go back and do the analysis to help us determine how to do just a little bit better? Those are the kind of things that we're going to get into, or what we've talked about here with our week 5 material. Again, get some help. If this doesn't seem obvious and easy to you, invest in some help. And good luck. I wish you all the best.